There is so much company news scheduled for the coming week that for once I'm going to cut out the macro and cut straight to the chase. Although do watch out for US house prices on Tuesday the 27th of July, a US Federal Reserve interest rate decision on the 28th, UK house prices on the 29th, and then the latest Chinese purchasing managers indices on Friday the 30th. Around a third of the FTSE 100 scheduled to release interim results in the coming week, and a fair few mid and small caps are slated to do the same. So it's going to be fast and furious. Ready? Okay, here we go. Names which may be worthy of note, either because of what they say about themselves, their industry, or the wider economy, or indeed all three, include the following. Although please do note that these dates could yet change in certain cases. Ryanair, Reach and Cranswick on Monday the 26th of July. Reckitt Benckiser, Polymetal, Croda, Moonpig, Greencore, Games Workshop and Virgin Money on the 27th. Fresnillo, GlaxoSmithKline, Smurfit Kappa, Rio Tinto, ITV, British American Tobacco, Dignity and Aston Martin Lagonda on the 28th. Shell, Lloyds, Johnson Matthey, Smith & Nephew, Sage, Segro, Diageo, BT, BAE Systems and AstraZeneca on the 29th. And then, to finish, NatWest, Rightmove, Pearson, Intertek, International Consolidated Airlines and Aveva on Friday the 30th of July. That's a heavyweight list. But even allowing for that, the company which could just cause the biggest fuss in the week ahead is Barclays. It'll be the first of the big five FTSE 100 banks to report interim results, and it's scheduled to do so on Wednesday the 28th of July. As already stated, Lloyds is due on the 29th and NatWest on the 30th, while HSBC reports on Monday the 2nd of August and Standard Chartered on Tuesday the 3rd. Banking shares have just started to come under pressure in the past week or so, even though the Bank of England has removed any final restrictions on dividends and buybacks, even though the economy is unlocking, and even though analysts have been busily upgrading 2021 profit forecasts for the big lenders. Interesting. Anyway, the net result is that Barclays shares are up by a good third over the past 12 months, way better than the FTSE 100's 10% gain over the same period, although they're now down by a sixth from their high. Given the importance of the banks to the economy and the amount of debt that's in the system, the share price slide is a trend that must be watched in case it's telling us something. When it comes to the numbers, though, the first thing that analysts and investors will look for is Barclays' headline pre-tax profit number for the first 6 months of the year. And for that first half, the consensus estimate is a profit of £4 billion compared to £1.3 billion a year ago. That underpins the analyst consensus estimate for the year, which is £6.4 billion against £3 billion last year, although do note the expected dip in 2022. Analysts will then dive behind the headlines to assess the key swing factors and check out the quality of the expected improvement in earnings. They've penciled in £110 million in loan loss write-backs, so that's a net gain compared to last year's £3.7 billion in losses and write-downs. And they've also put in just £69 million in litigation and conduct costs against £30 million at the first half stage a year ago. So it does look as if the bulk of the profit upswing is really from the absence of fresh loan write-downs. Then the loan book, well, at the first quarter stage, that shrank 8% year on year, while deposits rose 6%, to suggest customers were still risk-averse. It'd be a good sign for Barclays if loans were to start growing and deposits dropping. And then the net interest margin for Barclays UK fell again in the first quarter, albeit by just 2 basis points or 0.2% to 2.54% from the prior period. Stabilisation would be helpful here, as would a steeper yield curve and higher bond yields and interest rates, although those trends appear to be petering out. Attention will then switch to the balance sheet. At the first quarter stage, Barclays looked very robust based on the metrics it's obliged to report by regulators. It had a common equity tier 1 or CET1 ratio of 14.6% and a leverage ratio of 5%. Finally, analysts will look to cash returns. Barclays paid a dividend of 1 pence a share in 2020 and declared a £700 million share buyback. That's now been completed, and for the whole of 2021, analysts expect a dividend of 5.7p a share and an £800 million buyback. For the first half alone, by the way, analysts are looking for a dividend of 1.8p a share. Again, just keep an eye on that share price chart. It may just be the summertime blues, it may be the Delta variant, it might be the market's way of flagging something a bit more sinister. If banks aren't healthy, the chances are the economy isn't either, and do note that Barclays' stated book or net asset value per share is 267p, so the shares trade at just 0.6 times that as I record that podcast. Now, either the shares are too cheap or there's bad news on the asset valuations coming around the corner. It's up to you to decide which. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.